I keep hearing retirees say, I'm holding cash to buy the dip. A lot of comments, a lot of emails. People will ask me questions, and it kind of has, yes, and I'm holding cash to buy the dip. They're talking about when the market goes down 10, 20%, whatever number that you decide to use, the market dips by that amount. Opportunistic buy, put in 50,000, put in $100,000 to buy the dip and then ride it back up. Also, Warren Buffett, he's another voice in my head. He's keeping billions on the sidelines for an opportunistic buy. All this sounds smart, sounds disciplined, sounds like something sophisticated investors will do. Okay. But I ran the numbers over the last 10, 20, and 30 years, including reinvested dividends, kind of looking at this buying the dip scenario. And I'm going to roll that out for you here. One retiree, I'm calling Joe, he held $50,000 on the side of $1 million portfolio. $1 million was in the S&P 500, 50,000 on the side. And he is going to buy whenever the market dipped down. Another retiree, Lisa, stayed fully invested the whole time. Okay. Write in the comments whether Joe or Lisa at the end of 10, 20, and 30 years has the bigger portfolio. Okay. We're not spending out of this portfolio. We're just building it. Okay. Which one has the bigger portfolio? I'll give you a clue. They're all the same for 10, 20, and 30 years. So put Joe and Lisa in the comments. Okay. So I'm going to share my screen now to show you exactly how I looked at this. Okay, there you go. In blue here, you can say, this was my AI prompt. I put this in ChatGPT. I have the pro version. I pay for it. I get a little better answers, I think. So I typed in, this is just exactly what I put in a Word document and uploaded it into it. This is a YouTube video idea to buy the dip. I keep hearing about those retired people, they're opportunistic buy. How much is that really worth? Here's this two scenarios, Joe and Lisa. Joe has $1 million in the S&P 500, $500,000 on the sidelines in a money market fund, just waiting. Every time the market goes down by 20% from a previous high, the 50K is used to buy the S&P 500 at a low. This drop can come over days, weeks, months. Once the market then returns to new highs, I will sell my S&P 500 position, sell $500,000 of that to prepare for the next buy the dip opportunity. Okay, hopefully that makes sense. Re-listen if it doesn't. The 50K is put in a money market fund waiting for the next downturn. It's critical to note right here. Joe buys once the market first closes 10% below a prior high. I can't buy again until the market goes back to new highs. Okay. So you can't, sometimes the market goes down 10% and then goes down 5% more and then 10% more. It's got to go back up to new highs before I can reestablish my 50,000. So you may not be doing it this way, but I wanted a simple model that I could turn into a video here. Hopefully that makes sense. So I ran this scenario, said for the last 10, 20, 30 years, ending in full year 2025, included reinvested dividends and returns that you're getting in the money market fund. So we're comparing apples to apples. How much money would each Joe and Lisa have during these 3 time periods? How many times did it trigger? How many times did you sit on the sidelines and were able to buy the dip? Okay, Lisa has a different approach. Set it and forget it. How much money will Lisa have if she just kept 100% in the S&P 500 with a beginning balance of $1,050,000? Okay, so exact same amount of money for both of them. One keeps 50,000 on the sidelines. All dividends reinvested, run it for 10, 20, 30 years. Compare and contrast. That's the end of my prompt. Okay, now the ChatGPT result. Okay, for the 10% version, this is buying at a 10% dip. I ran this, separately for a 10 and a 20. So a 10% dip, okay, it triggered in 10 years 6 times. So 6 times I was able to buy the dip and ride the dip back up. 20 years, just 7 times, and 30 years, 11 times. Remember, those numbers may sound a little low to you, but it had to go down and then return up to new highs before I can refill the $50,000. It's not the same as converting every 10% correction. Okay, so that's how many times it triggered. Okay, now let's look at the 20% trigger. Okay, Joe had, after 10 years, 4.09 million. Lisa had 4.18, $94,000 more, 2.3% difference. 20 years, Joe had 8.23, Lisa had 8.46, a difference of 234,000. And that trend continued after 30 years, 19.5 million versus 20 point, let's say, call it 2. So all that work of buying the dip didn't work at the 20% trigger. 2, 3, and 4 times. It's only that's amazing. And I double checked this in Gemini to make sure it's only triggering a handful of times. So all this buying the dip, a lot of times you're sitting on the sidelines, and that's what's creating the difference. The 20% is big bear market drops. Here it lists a few of them. You don't need to know that. Here was the 10% trigger, 10 years, 6 events. Joe had 4.13, Lisa 4.19. Every scenario, 30 years, 19.65 versus 20.17. Every scenario, every time period rather, set it and forget it was a winner. Every one. The 10% version does better than the 20% version because Joe gets more opportunities to deploy the 50,000. But Lisa still wins. The set it and forget still wins. Because the gain on the 10% correction is not really that large. And, it's just waiting on the sidelines in cash or money market fund. This feels good, but it actually doesn't win to buy the dip. That I found this very fascinating. Buying the dip actually works, but keeping the cash around waiting is the problem. Joe is not wrong for buying at the dip. And if you did this one time, for an example, and just held it, hey, you got a 50,000 on the sidelines, it drops 20%, you buy and make no more transactions for the next 20 years, you'll probably be the better of the scenarios. You'll beat Joe and Lisa. Joe remembers the day he bought low. Lisa benefits from all the days she never got out of the market. 2 more things. Obviously, this is just an exercise. Perhaps you will buy the dip and hold it. Okay. That may work, but how many times are you going to be able to do it? Buy the dip one time? I don't know. Is that worth it? In my retirement financial planning life, boy, it's been 7 years now, and every month I keep striving for simple. Okay. Stop chasing $5 here, $5 there, a little bit better return, but a lot of activity to have money on the sidelines to buy the dip, but it just doesn't happen that much. And then when when you're buying the dip, you got this choice of when when do you reload to buy the dip the next time? You're kind of timing the market, and you got to time it twice. That dip 20%, was that at a low? When it goes back up to new highs? Do you leave it fully invested? Do you wait another year? Do you wait a couple more years? Do you watch the media and they'll tell you what to do? It's not for me. Staying invested appears to be the lesson. Staying invested. Well, let's go back to Warren Buffett. Buffett always kept money on the side for opportunistic buys. Why is it smart for him and I lose money when I buy the dip? Well, here's the ChatGPT response. Buffett is not doing the same thing as Joe. And when I say Joe, I'm talking about Joe in this scenario, not me. Probably shouldn't have used my name. It looks similar on the surface. Buffett holds cash. This is the exact printout of ChatGPT. I didn't edit this at all. Buffett holds cash. Joe holds cash. Buffett waits for opportunities. Joe waits for opportunities. Same thing, right? Well, Buffett is not waiting to buy the S&P 500 after a 10% dip. Joe's rule is mechanical. If the S&P 500 drops 10%, 20%, that's when I buy. When it recovers, that's when I buy back cash. Buffett He's looking for mispriced businesses, distressed deals, private acquisitions, preferred stock deals. He's got a whole nother thing he's doing, and he's buying and holding. That's a huge distinction. Joe is saying the market is down, I'll buy the market. Buffett is saying something is mispriced, and I have the size, reputation, and structure to negotiate a deal others cannot get. Buffett, he also has cash for his business purpose because he's an insurance business, so I don't want to go into that one. Buffett can buy things I cannot: preferred shares, high dividend coupon deals, warrants, private negotiated terms, whole businesses, rescue capital opportunities. He's got a whole group of other things that he's able to buy. I can give you capital when no one else will, and I want special terms, quote unquote. That's not the same thing as buying the dip. Okay. I don't want to cover number 4, but it says Buffett's cash is often earning real money. There wasn't much juice inside of there. Buffett is not forced to sell after the market recovers. He tends to buy businesses and keeps them long term. Not the same as the strategy that I lined out for Joe above. Okay, Buffett's goal is not the same as Lisa's goal. His goals are much broader. Protect Berkshire, maintain liquidity, keep insurance strength, avoid dumb deals. Simple explanation. I like this. This is the end. Buffett holding cash is not the same as a retiree holding cash to buy an S&P 500 dip. Buffett is running an insurance company, an acquisition company, and a capital allocation machine. He can negotiate deals, buy enterprises, provide rescue financing, and demand terms ordinary investors cannot get. Most of us are not just buying the same. Most of us are just buying the same index fund everyone else can buy. So if you're influenced by what Warren Buffett's doing and saying, boy, he's got cash on the sidelines waiting to buy, or if you buy the dip, it makes sense. You're buying things on sale. When do you get back in? Hopefully you've learned a little bit through this scenario that, that time that your money is, I'm going to stop sharing. That time that your money is sitting on the sidelines doing nothing is a big deal. So before you set aside money to buy that dip, go back in history and see how many times you would have bought that dip based on some mechanical, triggers. Like I'd use 10 and 20% dips. Those are, common that I hear people talking about that automatically trigger event. When are you going to get back out? And if you're on the sidelines for many months, many years, you're maybe missing out and doing all this activity and just adding stress to your life. I thought you would enjoy this video. Let me know in the comments. And how did you do on your initial guess whether it would be beneficial? Were you on Team Joe or Team Lisa? Team Joe was having cash on the side to buy the dip. Team Lisa, I'm just all in all the time. Which team were you on, and did you get a different result in this analysis? It's Joe out.